QuickBooks Pro Desktop 2021. How do bank feeds fit into my accounting system? Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are on the desktop where we have the QuickBooks program, and then we housed our data file into our folder to the right. So our data file is now here with our QBW file. We can double click on either one in order to open the company file that we have set up for our test file. Let's do it this time by opening up the program first, and then we'll locate that test file. If the test file was the last thing you had open, it's going to go right into the test file. You'll see it up top. If it was not, then it'll go into your other file, whichever one you had open, and you can close the test file, File tab, close the company file, and then you should be able to find it basically in the open windows here. So you can just open up the test file, which will be in the open windows. Now, if you have multiple test files, and they have the similar names, then you're going to want to find the actual location of the file, and you could do that by actually double clicking on the file to open it, or you could go to the file drop down and say you want to open or restore the company file. In this case, you want to open the file. This is another way that you can open the file that we already have open here, and then you can locate it once the program is open. We put it on the desktop, and then we put it on our test file. We had a test file, I believe, bank feed test. That's the one. QuickBooks data file, bank feed test file. So that's another way that you can get in here. So we want to make sure that we have the home page open, and we're going to open the home page by going to the company drop down and make sure you have the home page open. It should be open by default. What we want to do on the home page is look at these cycles that are involved. This is an accrual type of cycle, or the full cycle that would typically be involved with, say, the accounts payable or vendor cycle or payable cycle, the customer cycle or sales cycle or accounts receivable cycle, and the employee cycle or payroll cycle down below. So what we want to think about is, well, if I'm getting the feeds directly from the bank, how is it going to fit into my accounting system? And it'll depend on what type of accounting system you're using. So to get an idea of that, let's just think of a mock bank statement. Here's a mock bank statement. Here's what the bank statement has: beginning balances, additions, deductions of the cash account, ending balance, and then it's got more information with regards to the deposits, the actual deposits that were made, which is breaking out this into the actual deposit, and then the checks, the actual checks that were written, or other kind of decreases, which could include electronic transfers and whatnot for the detail of that activity. So that's all it has, is stuff that, of course, went through the bank account. So now we can think about, well, what can we do with this in order to build the books? And it can be a little bit deceiving when you see the advertisements for like kind of bank feeds, and even the name of QuickBooks can make it seem like, well, you're just going to connect to the bank, and then the bank feeds will go into the system, and then the whole thing will be made by just connecting to the banks, and your financials will be done for you. It's not going to be that simple, but it can be more or less simple depending on the type of organization you have. So let's first think about the type of organization. Would be as easy as possible to simply rely on the bank feeds to make the bank feeds, basically building your books from the bank. And that would be a type of company where you're okay with relying completely on the bank in order to generate your books, which is not normal full service bookkeeping. In that case, in full service bookkeeping, we would typically be doing the books and then using the bank statement as a double check on it. But there could be some situations, some small companies might say, hey, look, I'm just going to be completely dependent on the bank. I'm going to use the bank statements in order to create my books. And that would be the easiest use of the bank feeds. That would be closest to kind of the idea that you're just going to basically connect to the bank, and then all your financials will be made for you. But just note that will only work in specific needs. If you don't need a lot of detail in your books, if you just basically want to record the revenue and the expenses, and if you're able to basically say that all deposits that go into your account are in essence revenue. So if I'm able to say, hey, look, everything that's an increase in my checking account came from a customer, and I'm just going to record it as revenue. Now, if you're taking the information directly from the bank, it may be difficult to know which customer is giving you the deposit, depending on how it's going to be grouped in the statement. They might give you that information if it's electronic payments on the bank statement, but they may not. So you might not have the detail in that case of who paid you. You may not care, right? If you don't care who paid you, if you just know it's an income and you just want to increase income so you can report the income and have that information, then that would be the easiest thing to do if you're building your books directly from the bank statement. And then if you say that all checks or all decreases are basically expenses in some way, shape, or form, then you can assign each of the decreases to the proper expense account, and that would be the easiest way to set things up for a small company that is okay with being completely reliant on the bank. And you're going to lose some of the kind of things that you would be getting out of a full service bookkeeping, including you might not have as much detail on who paid you, or as much detail on the vendor side. You're basically just recording it as an expense. You probably have some of the vendor information and can populate it. And you're on a cash basis as opposed to an accrual basis. When you do that, not only are you on a cash basis, but you're on a cash basis that's completely reliant on the bank. There's no double check, as is normally the case. Even if you're on a cash basis under normal accounting circumstances, you would record the transactions on your side, and then you would double check that they cleared the bank. And that's different, because if you were to do that, for example, when you write a check, you write the check, you recorded it on your side, you know you wrote the check. The bank doesn't know until some later point in time. When the bank clears the check, then you can verify that your check cleared the bank. If you don't write the check, if you don't record the check into the accounting system, then you're dependent on that check, the bank saying whether or not that check cleared or not. You don't really know if a check hasn't cleared, because you were not entering the check into the accounting system. We're simply waiting till it clears the bank, and then we're creating the books from it. So that kind of simplified system is the closest thing to the idea that you can just put the bank feeds on and put it in and put everything into the books, and it will basically populate itself. And even that you still have to set up, because the deposits, any deposits you have, you would then need to set them up as a deposit. That should be fairly easy. And all you need to do is break out. In that case, you would need to break out the types of deposits that are not from the customer. Otherwise, you will record them as income and probably be paying taxes on them. Those deposits would include loans that you took out, possibly cash going up because of a loan rather than something coming from the customer, and deposits from an investment from the owner. If the owner puts money in, it shouldn't be recorded as income. It should be recorded in some equity account. And then on the expense side of things, it would be a little bit more difficult still. We'd still have to take those bank feeds, because the bank knows the vendor. They don't know the actual expense account. So then you would have to go through there and assign all the vendors to the relevant expense account. For example, the phone company would have to be assigned to telephone expense, and so on and so forth. Once you do that for 1 or 2 months, however, the system will be better at memorizing that information, and then it'll become more and more automatic. So after a few months of data input, if you would do this very simple system, then you might be pretty close to it being as automated as possible for just letting QuickBooks basically build your books from the actual bank statement. Now, if your books are a little bit more complex than that, then you've got to think about what you're going to do, and when would that happen? Well, the most common way that happens is when people are creating invoices. So if you're in the type of company where that you do the work before you bill the client, like a law firm or a bookkeeping firm or something like that, then you're going to be utilizing invoices. You're going to have to say, I'm going to bill this person and I expect to be paid in the future. When you do that, you're entering something into the system that isn't involving cash. It doesn't involve cash. It involves accounts receivable and sales. And then you're expecting to receive payment at some future point. And between that point, you're tracking whether or not, whether they have paid you, so that you can collect on it. You're going to follow up to make sure that they're going to collect on it. So that's tracking accounts receivable. So if you have accounts receivable and are tracking accounts receivable, or if you use this invoice as a billable item, something that you use to bill the clients, then you're no longer on a cash basis. You can't really use the system that we were looking at before, because you've got this other component. So then you got to think, well, in this cycle, if I create the invoice, then I'm going to receive a payment on that invoice at the future point. That's when it could affect the cash account, or I might put it into undeposited funds and then put it into the cash account over here. At this point, why would that happen? Well, it depends on how the invoices are being grouped. So if you're getting your payments in cash, then obviously you might take all that cash and then go to the bank at the end of the day and deposit it into the bank. And you've got to group your deposits into the bank in the same way that they'll be seen on your book. So you're going to have to then record the invoice, record the receipt of the payment, all cash receipts and whatnot, deposit it into the bank, and you got to deposit it in the same way in your books as it will be seen on the bank statement. So if you were to do that full process, then you would basically still have to record the full process on your end, independent from the bank, and then verify to the bank. So when you got the bank feed would just be a double check. It would be a verification. It would be like you doing your bank reconciliation, comparing what you did on your side to what the bank did on their side. It's just a double check, which makes it a little bit easier possibly to double check if you have the bank feed, because then it'll basically help you do your reconciliation as you go. But in that case, you won't be creating your books from the bank feed. You'll be basically using the bank feeds as a double check. You may also have that issue if you're getting like credit card payments and the credit card third-party company is batching your credit card payments in some way, that you're going to have to record into the bank in the same way that it'll be seen on the bank statement. So that's another way, because you have to tie out the received payments to the invoice, and you have to be able to figure out how you're going to do that so you can track the accounts receivable that are outstanding. On the other hand, if you create an invoice and you just get a payment one by one, check by check, or electronic payment by electronic payment, and then you put that one check into the bank, then you can basically record the deposit at this point directly into the bank. And so in that case, in that system, you might be able to take basically the bank feeds and tie them possibly to open invoices, or at least you can double check the bank feeds to this second component. But again, if you're using invoices, obviously, then you have to somehow tie out the invoice to the receipt of the payments, and that's going to complicate the bank feeds to some degree. You got to kind of figure that out. So that's like the main place where people have issues with the bank feeds. If you're doing sales receipts in the store, meaning you're actually selling things in the store, and you got people coming up to like the cash register and you record a sales receipt, this is the point in time that you would get the cash and you would be recording sales at this point in time. Again, if that were the case, you're probably getting cash or at some point of payment, or different types of payment methods, and then you're probably going to the bank at the end of the night, and you're going to be depositing into the bank the cash, not as one lump sum, but as one lump sum, not as individual receipts. So therefore, you're probably going to have to go through this undeposited funds in order to record the cash, unless you want to just collect the cash all day, right? And then record, and then just take it to the bank, and not even, and then rely on the bank, right? And wait till the bank feed clears to record the actual sale. But if you're recording this item, create sales receipt, when you make the sale, then that's going to record an increase to either undeposited funds or cash at that point in time, the checking account, and the other side is going to go to sales. So if you use this then, and if you put it into the checking account at that point in time, then you want to make sure that it's going to show up on the bank feeds, on the bank statement, in the same amount that you group it here as. And usually if you're collecting the sales, that's not going to be the case. If you're collecting at the day, because you're going to be getting some cash sales that you'll deposit in a group lump sum, and therefore you're still going to have to go through the process of basically grouping it together, going to the bank, depositing it into the bank, and you're probably going to want to record it in QuickBooks as you do so you can double check, using the bank as a double check in that case, rather than relying on the bank to record the transaction. So those are the receivable side, is probably where small businesses are going to break away from just this completely cash basis method. And then we have the vendor side, which if you're a small business and a service business, then you may not have as much on the payable side. You might be basically making the payments with cash, meaning you might not be entering the bills for like the phone bill or the utility bill and whatnot, and then paying them at a later point. You might simply be paying them as you get them, electronically or by check. And in that case, you could be more reliant on the bank feeds. However, it would be better to actually enter the checks and then use the bank feeds as a double check. In other words, if I was going to write a check to the utility company or the phone company. I should actually write the check, physically put the check into the system, and then I can track whether it has cleared or not. Then I'm going to use the bank feeds, which is kind of like a bank reconciliation, to verify whether or not the check has cleared, when it clears, because it's going to clear at some future point. And so in that case, you're doing a double check. You're recording the transaction when you made it, and then you're double checking when it clears the bank. And so you'll be able to double check that. Now, many people are going to online payments now. So if you do all of your payments with online electronic transfers, it would still be better for you to enter the electronic transfer as basically a check type form, meaning a decrease to the checking account, and then waiting until it clears the bank to do the same process, double checking that it has cleared the bank. That gives you two recordings, one on your side, one from the bank, that you're double checking and simply reconciling. However, many companies may not do that. If you're a small company, you might say, hey, look, I'm just going to make the electronic payment. When I make the electronic payment, and I'll rely on the bank. I'm just going to rely on the bank to record that transaction, and then when the bank feed goes through, then I'll record it. I'll assign it to the proper expense account at that point in time. So in other words, I will not enter the payment, whether I enter a bill or a check, when I make the payment, because it's an electronic payment. I'm just not going to record it. I'm going to wait till it clears the bank, and which should be pretty quick, within 3 days, because it's an electronic payment. And then I'm going to record it at that point. You lose some security doing that because you're relying on the bank. You're not recording it on your side. You're not double checking two sets of books, but rather being dependent on the bank. But because there's not a huge lag with regards to when you write the check could get lost in the mail and whatnot. And when it clears, that's not as risky as it would have been when you're doing handwritten checks, and many small companies will most likely do that. Now, if you were to have inventory, that's going to confuse things a lot as well, because inventory by its nature means that you're going to be tracking something as an asset. So let's turn on the inventory, and we'll see another line up top. So if I go to the Edit, go down to the Preferences tab, I'm going to go to Items and Inventory. I'm going to go to the second Company Preferences, and I'm going to turn on the inventory. So we're going to turn on the inventory here. I'm going to say OK, and QuickBooks must close. It's going to close all the windows. Say, all right, close all the windows. And then I'm going to go to Company and open the home page again, and we will see now it gave us this thing up top that tracks the inventory. So inventory, there's a couple of different ways you can think of the inventory. One way, the easiest way you can think of inventory, and this would be like if you don't have a lot of inventory on hand, like you could try to do inventory on a cash basis. And you talk to your accountant on this. The tax law requires some treatment differently for inventory and whatnot as well. Inventory is usually a place where you have to move from a cash basis to an accrual basis. But again, if you have very limited inventory, the easiest thing to do is to stay with a cash basis. Meaning, like when you buy the inventory, usually you put it on the books as an asset. But I mean, if you were to expense it at the point in time you purchased it, so for example, if you were to purchase, in our case, guitars, and we purchase custom guitars for a specific customer, then they might order, we might order a guitar, and when we order the guitar, maybe we, instead of putting it on the books as inventory, maybe we just record it as an expense at the point in time that we purchase it. And then when we make the invoice, all we need to do is record an invoice as if it was similar to a sales item. In other words, the invoice will be increasing the accounts receivable, increasing sales, and will not have to decrease the inventory and record cost of goods sold and whatnot. Although you still have to deal with sales tax in that situation as well. You'd have to make it a sales taxable item. So that would be the easiest thing to do. When you buy the inventory, you just expense the inventory. But if you have a substantial amount of inventory, you can't really do that, because that's when you need to deviate to an accrual method. So that means when you buy the inventory, you're going to have to put it on the books as an asset, and then you can't record the expense until you sell the inventory, and that's usually when you have the invoice or the sales receipt. So the invoice and the sales receipt on a perpetual method would be decreasing the inventory every time you make a sale. So you could, so if you have the inventory and you're thinking about how can I fit the bank feeds in there, if you were to say every time you purchase something from a vendor that you're going to resell and you just record it to cost of goods sold, then you'd be on a cash basis, and it would be just like kind of any other bill that you would basically be dealing with. However, if you're going to record it in inventory, then you got to think about, okay, every time I pay this vendor, I'm going to be increasing the inventory, and then you'd somehow have to track the inventory as well. You could do that within the QuickBooks system, or possibly you can track it outside of the QuickBooks system and just record the transactions. In other words, if you do it in the QuickBooks system, you would use a perpetual system. If you do it outside of the QuickBooks system, then maybe you can do a periodic type of system, a manual count of the inventory from time to time to record the decrease of inventory on a periodic type system. But in any case, the inventory is another area that you got to consider. How are your bank feeds going to fit into the inventory process? If you have questions about inventory and what are your options with it, I highly recommend looking at we have a course on just inventory, so you can get an idea of what the normal flow of inventory is, what's a perpetual inventory system and a periodic inventory system, so that you can then think about, well, what would be the best system that you could put in place to run your books. And then you have the payroll down below, and payroll is another area which is going to be confusing because you have to provide more information to the client than just the net check. You got to provide them with the pay stub some way that will show them the amount of withholdings that were taken out. So you can't simply depend, if you're running payroll through QuickBooks, you can't simply depend on the bank feeds typically, because you're going to have to process the payroll through the QuickBooks system in order to process the information related to the payroll withholdings. Now, if you have a third party that's recording the payroll, like an ADP or a Paychex, then you can think about, well, how are you going to record the decrease to the checking account that's being recorded, and then you can have the third party possibly deal with that added component of providing the added detail of all the withholding information. But it's still going to be a little bit more complex because there's a lot of accounts that are affected when you record the payroll. So that's just going to be kind of an overview of how the bank feeds fit in. So if you're in a small company, you might be able to rely on the bank. And then if you're going to an accrual system, you're going to have to expand your vision out and think about, well, how do the bank feeds fit into my system where I have my needs of accrual, whether that be invoicing, accounts receivable tracking, accounts payable tracking, inventory issues, or payroll issues.